The infinite banking concept, cost recovery strategy. Now the objectives of this strategy are: 1, to increase cash flow and profit margins; 2, recover part or all of monies spent on targeted expenses while still recording them as an expense to the business; 3, recover the lost opportunity cost associated with these expenses; 4, apply a banking model to your business; 5, use the banking model to become your own financing source for future expenditures; 6, get money out of your business on a favorable basis to help supplement retirement. Now, these targeted expenses can be any kind of expenses that you want, whether they be for insurance, could even be for equipment or vehicle purchases. You decide what expenses you want to target for this strategy. Also, I want you to remember increasing cash flow as well as profit margins. Now, the current method that we use to pay our bills and fund our operations is illustrated here in this flow chart. You have revenue coming into the business of $50,000. Goes into your business, goes back out to pay for $50,000 of expenses that you have, and then you end up with zero balance. Now, the example I'm going to give you is, or the scenario, is going to be over a 20-year period, where every year for 20 years you have those ongoing expenses that you want to target, and it's going to be $50,000 in this example. Every year for the next 10 years, you'll pay those $50,000 in expenses for $500,000 total. After 20 years, you will have spent $1 million in those expenses. To pay a $50,000 expense, you must make at least a $50,000 deposit. $50,000 in revenue funds a $50,000 expense, leaving zero balance. Now, at the end of the day, besides the expense being paid, which is a good thing, you have nothing to show for it. That's the way we normally do it. Now, here's an illustration that is going to kind of show how this works. Disregard this 1% column here. That applies to the next illustration. It's a very simple illustration. It shows $50,000 a year going into your account and $50,000 going out to pay those expenses every year. After 20 years, you've paid $1 million in expenses, or you've made $1 million in deposits into your account to pay those $1 million of expenses, and you have a zero balance after all that time. Now, let's suppose that we applied a banking function to the way that you do business. Let's do things a little differently. So how do we do that? Well, let's separate the business from the business owner. Now, the owner is going to loan the business $50,000 to pay the expenses. That $50,000 could be from cash flow, could be from bank accounts or brokerage accounts that you have. But you're going to loan your business the $50,000. Your business is going to repay you, the owner, with revenue that normally funds the expense, that $50,000 of targeted expenses you want to recover. The owner will charge your business 10% for the use of this money. The business still deducts the expense, but also deducts the interest paid on the expense to you, the owner. Now, you have the $50,000 expense. You do that over 20 years, you have those $1 million of expenses that you will be paying. let's suppose you're making that 1% interest on the money that you deposit into the account, that $50,000 you deposit every year to cover those expenses. Let's suppose you're earning interest 1%, and that you earn a tax rate of 30%. So you loan your business $1 million over 20 years. Your business repays you $1.1 million principal and interest of 10%. You will have earned the 1% on the balances on that account. You've paid $39,466 in taxes during that time, but you end that 20-year period with almost $1.2 million in your account. So business as usual, you pay those expenses, don't get anything back. If you apply a banking model to your business, you end up with almost $1.2 million. Here's a flow chart to help illustrate what I'm talking about. You have revenue coming into the business. Here it says 100,000. It could be any amount, 200, 500, whatever. Revenue is coming into your business, and you're using that revenue to pay expenses. Here you have $50,000 of other expenses. Over here you have the business owner. You deposit $50,000 into an account. You turn around and you lend that money to your business. Your business in turn uses that money to pay the targeted expenses. From cash flow, your business now repays you, the owner, the $50,000 plus 10% interest, or $5,000. This process is repeated year after year. The business is still deducting the expense and is also deducting the interest paid to you on that expense. Here's an illustration that shows what I'm talking about. Here in this column you see the $50,000 that goes into that account every year that's needed to pay the $50,000 of expenses. Here's 1% interest that you earn on the account balances during that time. You earn some interest. This is the 1% earnings. And of course you will pay taxes on those earnings, since it is a taxable account. And the $50,000 that goes out to the targeted expenses to pay those, and of course the loan repayment that you have here of $55,000 total. So you've loaned out $50,000, you received $55,000, you've earned some interest, you've paid taxes on the interest, you have an ending balance of $55,350. Year 2, you deposit another $50,000 into the account, you lend it to your business repays you the $55,000, you earn 1% interest, here's the earnings, you pay taxes on that earnings. At end of year 2, you have $111,000 and some change in your account. Year 3, another $50,000 deposited into the account, you loan it to your business repays you the $55,000, you earn 1% interest, $1,611, you pay some tax on it, almost $500,000. You have an ending balance of $167,215. You do that year after year after year for 20 years, depositing the $50,000, being repaid $55,000, earning interest, paying taxes on an interest, and having an ending balance at the end of the year. So you see here that at the end of 20 years, you've paid $1 million. You've made $1 million in deposits. You've paid $1 million in expenses. You've been repaid principal and interest of $1.1 million. But at the end of 20 years, instead of having zero to show for it, you have almost $1.2 million in your account, $1,183,801. Year 21 just shows you not touching that money, not taking any expenses or loans, and your account grows. You still pay taxes on it. But after 20 years, you have almost $1.2 million in your account. So the question is, do you want to continue to do business as usual, deposit $50,000 to pay the $50,000 of expenses and end up with zero, as in the previous scenario? Or do you want to apply a banking function to your business and create wealth? Take money that you're not doing anything with, that's sitting idly, put it to use like a bank does, become your own bank, and create wealth. Now imagine this just for a minute before I end this first video. What if you earned more than this 1%? What if you didn't pay these taxes on the earnings? You still had earnings in this column, but zero taxes here. How big would this balance be? Think about that. Because in the next video, I will show you the IBC way of doing it. Infinite banking concept alternative to this. And I think you'll be pleasantly surprised.